Hey, this is Brant from TradeGuild.net. It is October 6th, another crazy day in the markets. Last night, about midnight before I went to bed, I took a look at the Asian markets. They were down big, between 4 and 6%. The European markets were down big on a bank bailout in Germany. So this morning, the Federal Reserve doubled the TAF fund to $900 billion, and they are going to begin paying interest on required deposits and reserve balances. The euro, and let me pull up the dollar index. The euro fell 2.2% to $1.35 versus the US dollar, which rallied 1.5%. And today, the Dow and all the other averages set multi-year lows. We'll take a look at the Dow 30 real quick here. So multi-year lows set in all the averages. The Dow at its low point today lost 7.8%, a huge loss. Nasdaq down 8.8%, and the S&P 500 down 8.3%. Now, all the averages, towards the end of the day, they gained back about half of what they lost. So in about the last hour and 15 minutes, the Dow gained back 500 points. So that was a pretty amazing end of the day. Here's the VIX, which is the Chicago Board of Options Volatility Index. And today, here's a daily chart. It set a new high at 58.24, closed at 52.05. If we want to see a high that was at this level, somewhere around this level, we have to go and look all the way back to October of 1998. So way back. So volatility index has an inverse relationship to the market. When we see spikes in the volatility index, it usually marks a low point in the market, and the market generally rallies from there. High numbers above 30 generally represent fear in the market, and low numbers represent complacency. When we have low numbers, the market tends to be near tops and sells off. So the VIX showing the market is very oversold. The last time, in October 1998, the SP 500 was in a 3-month downtrend, and it had lost 20% by the time the VIX hit 60, and it rallied from there. Let me pull up DBC, and this is the ETF for tracking commodities. You can see that commodities sold off today. The CRB index lost 5.2%. Basically, there's fears of global recession, and all the commodities are selling off. Gold was one of the exceptions. Gold rallied 4.4% to $865.50 per ounce. Basically, that's a flight to safety trade. People taking their money out of stocks and going into gold. If I pull up oil real quick, here's X oil, which is light sweet crude. And you can see oil had a bad day. Crude closed down 5% today to $89.15 or 75 cents per barrel. Can't remember which one. The best performing sectors today were specialized finance was up 3.6%, building products up 1.42%, auto parts up 1.2%. So not a lot happening there. The worst performing gas utilities, and let me pull up one of the stocks and gas utilities. Here's Questar Corp. Gas utilities down 10.24%. Healthcare facilities down 9.8%. And here's Tenant Healthcare. You can see them. Power producers and power traders down 9.13%. Here's AES. You can see down 11% there. Agricultural chemicals, they got hit hard today, down 9%. Here's one that's probably a pretty good candidate for a bounce. This is Monsanto. Other ones that were down today, oil and gas drilling, managed healthcare was down, and auto manufacturers were down about 7%. Here's the S&P 500. We're going to look at a 5-day chart of the S&P 500. Let me zoom out a little bit. And down at the bottom of the chart in green here, I have a 14-period RSI, Wilder's RSI. And we're going to look back to about 1998. And basically when RSI hits a level below 30, and you can see over here 24.25%. When it hits a level below 30, we generally see rallies, so it marks an oversold condition. Here you can see in 1998 we got below 30. We saw a nice rally from there. Over here in 2002, got below 30. That marked the bottom of the tech bubble bear market. Recently, Over here we got a little rally off of this little plunge under 30, and now again we're quite a bit under 30. So it looks like we're in a very oversold condition on the weekly. If we look at a monthly chart, we can see again on a monthly chart, last time we saw numbers below 30 were at the end of the bear market, the end of the tech bubble bear market in 2002. So on the monthly, actually that's a 9-day, here's a monthly. So on the monthly, on the weekly, and now on the daily, we have 3 RSI divergences down below 30. So we're looking at a very, very oversold market that's really ready to bounce. The rule with oversold markets are there is no such thing as too oversold. They can always become more oversold, sell off even more. But the more they go down, it's almost like a rubber band, builds tension, and eventually, when they do rally, that tension snaps back, and we get a really nice move to the upside. So we're looking for that move to the upside. Again, with this S&P 500, I want to show you another 5-day chart. And we're going to zoom out to about 2002, and I'm going to put some Fibonacci lines here on the chart, and we're going to catch roughly these 2002 lows over here and up to about 2007 high. Just adjust that a little bit, and basically what we have is this level, which is the 62% retracement of the entire bull market rally. So here's 25%, 33, 50. We're down at 62%, which is the typical retracement for a bear market correction. So again, we're in the area of where we might expect to see a pretty decent bounce. That Fibonacci level is really at about 1077 on the SP 500. Let me pull up the spiders, which is the ETF for the S&P 500. And we're going to look at a daily chart here. And something I wanted to show you, if you're into candlestick formations or candlestick charting, we have what is called a hammer down here, which is a pretty reliable reversal signal. It looks like a hammer. Basically what happened is up here at the top of this green body, that's where the market opened. This is the low of the day, and this is the close of the day. So basically the market sold off and then rallied back up towards the close. It forms this candlestick. This is Japanese candlestick charting, been around several 100 years, and rice traders used to use it. Very powerful charting system on its own. Here you can see another hammer, which we got a nice bounce from that. But these hammers are a pretty good reversal signal, so reversing this downtrend. So we're looking for a reversal off that hammer. Also, the volume is huge over here. I posted tonight on the website my contributors letters from today, so you can read those. And what I was talking about, one of the things I was talking about was our close on Friday. I didn't think the volume was big enough for a capitulation day, which is a typical reversal sign. So what I mentioned was I thought we might get one more big nasty gap down, and hopefully on good volume, increasing volume. We got that today. So this looks more like a capitulation day. Capitulation is basically when all traders and investors basically just throw their hands up in the air at the same time, throw in the towel, sell off huge, and that's when buyers see an opportunity and they step into the market. Here's a 1-minute chart of the S&P 500 ETF, the spiders, and what I want to show you was let me get out a marker here. This little range over here in the morning from about 9:30 to 10 o'clock, this is a trading range that we see typically in mornings. I'm going to switch to a 5-minute chart so we can take a little closer look at this. Let me just pull out a couple trend lines here.